do not like taking risks. They prefer lower returns instead of higher ones because the lower return investments have known risks. The higher return ones, on the other hand, have unknown risks. We also use the term risk-averse outside the world of business. For example, listen to this phrase. She believes that attitudes today to children's play are too restrictive and risk-averse. In other words, she thinks adults are overprotecting children. When you present risk-averse individuals with several investments giving the same return but with different levels of risk, they will always opt for the least risky ones. Risk-averse investors have a low risk tolerance. Risk aversion is a survival instinct that humans and other animals have. Risk-averse investors contrast with their risk-loving counterparts. A risk-loving investor is excited by the prospect of making a fast profit, even though the investment is risky. Most of us are somewhere in between. We tolerate some risk, but not too much. Humans' attitudes to risk are not consistent. Some people are risk lovers when it comes to sports and hobbies. However, they may be risk-averse when deciding where to invest their money, and vice versa. Risk-averse investors avoid risk and stay away from more speculative investments. Such investors like index funds, government bonds, and debentures. In fact, even with bonds, those who do not like risk probably favor laddering. Laddering means purchasing several bonds with different maturity dates. Laddering is a strategy that reduces risk and helps maintain a regular income. Risk-averse consumers are less likely to accept a bargain if the payoff or benefit is uncertain. They will also tend to choose the same product at the normal list price if the payoff is certain. When choosing a second-hand car, a consumer with risk aversion will purchase one from an official dealer, especially a dealer who offers a 6-month guarantee rather than a bargain with no guarantee.